And welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions with their money, their careers, and their practices. I'm your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, a financial planning firm just for optometrists nationwide. And on today's episode, I have another awesome guest, Joe Erickson, owner of Erickson Tax and Accounting, and we dive into end-of-year tax planning considerations for the W-2 employed optometrist, the self-employed or independent contractor optometrist, as well as the private practice owner. So regardless of which direction you're taking your career, there is something to learn and take away from this episode. And if you have any questions on anything we talk about in today's episode, feel free to reach out to me by email, Evon, E-V-O-N, @optometrywealth.com. Or if you have any ideas or topics for future episodes, you can find all the information and resources we mentioned here in the episode in our show notes, which are at the Education Hub on my website, www.optometrywealth.com. And while you're there, feel free to schedule a no-commitment introductory call, and we can talk about whatever is on your mind financially, and you can learn about how we help optometrists all over the country plan for these end-of-year tax and financial planning considerations. So without further ado, here is my conversation with Joe Erickson. And welcome back to the Optometry Money Podcast. I am your host, Evon Mendrin, and I have another awesome guest joining the show. We'd love to welcome Mr. Joe Erickson with Erickson Tax and Accounting. Thanks for coming on.
No problem. It's great to be on and excited for our conversation.
Yeah, so we are going to talk about something that I think are on a lot of people's minds as we start to get to the holiday season, towards the end of the year. It's all right, tax season is right after that, right? We got Thanksgiving, we got Christmas, followed by an even more joyous season, tax season. And so a lot of conversations are now about, okay, now as we get to the end of the year, how do we prepare for this tax, right? Most of the time it's like, how do we lower this tax? Like what can we do to try to get as little tax into the year as possible? But I want to talk to you about not only just what are some ideas to think about as we get to the end of the year to lower the tax, but just to prepare for it in general. And some ideas about lowering taxable income and some thoughts around, okay, how do we think more long-term strategically about tax planning? So, and I want to talk to you from the perspective of that employed optometrist, of that self-employed 1099 optometrist, and also that practice owner. So we've got a lot to try to fit into this conversation here. But before I dive into the questions here, why don't we just get a little bit of a background from you? Tell us about you, your background, your firm, and what you're doing.
Yeah, I can tell you a little bit about that. Well, I guess first we'll start with my background. I've been a CPA since 2012, so I've been doing this for 10 years now. Previously worked for a bigger firm that specialized in investment management along with tax prep and tax planning. And then at the beginning of 2021 is when I broke off and started Erickson Tax and Accounting. My main specialties at my firm have been dentists, optometrists, and real estate investors. So kind of just those three are kind of most of my client base falls in one of those three kind of categories or multiple of those categories when you count the real estate investing with either dentist or optometrist, and figuring out strategies specifically mostly related to medical professionals in terms of like tax planning and tax savings where we can find them.
Yeah. And I'm always curious to know like why people decide to leave one stable employment and go on to start their own thing. Why did you leave that last job and start your own firm?
I think it's just kind of like exciting to start your own firm and just kind of something new. You've been doing something for a while and you kind of want to take a risk and do something on your own. And it's just kind of like, I mean, I think a lot of people that are probably listening to this are business owners themselves, where they're like getting to the point where you say like, hey, I've kind of done what I want to do here and want to just try something new. Yeah.
I mean, and that freedom is really cool when you get to design the business and the service that you're providing as you want. Like you get total freedom and control over that whole experience. So that's pretty cool. So let's dive into the fun, right? Let's talk about tax. And
let's do it.
Let's start with that employed W-2 employed optometrist. What are some things that optometrist should be thinking about in terms of helping to plan and prepare for that tax, but also maybe to lower that tax or just to plan more strategically?
Yeah, that's like kind of an interesting conversation to have too, because unfortunately the answer is for employed optometrists, there is not as many options where if
Yeah.
you have your own business or are working as a 1099. Couple of the things that we want to make sure that you're aware of is that if your employer offers a 401k, a simple IRA, some type of retirement plan contribution that you can contribute into, that's going to be your best bet for contributing money somewhere where you can lower your tax liability. Most employers will offer some type of traditional, either 401k or traditional simple plan that you can, simple IRA that you can put money into. There will be some that offer like a Roth option as well, which that is kind of a tax strategy where it doesn't get you any immediate benefit. But depending on your age and what you are anticipating your income to be in the future, it might be more advantageous to put that money into a Roth now where that will grow tax free than getting the immediate tax deduction on the traditional 401k, where then you will have to then contribute that or pay tax on that money when you withdraw it in the future. That is going to probably be your best option for most people that are employed ODs. The other thing just to be aware of for a lot of fresh out of school ODs where you're working your first full year, where say you're making, a good OD salary of, between $100,000 and $150,000 a year. One of the things to be aware of is that when you fill out your W-4 for having tax withholding done for the year, it doesn't necessarily withhold enough to cover your tax liability. Because what I often see a lot of times too is people that are used to getting refunds kind of start their first job out of optometry school with like at a higher salary. And then they get into a situation where they fill it out as say like single zero. So it's withholding the max as per the instructions. But even with that, it still doesn't withhold enough and they end up owing at year end. So it's also kind of a thing too, in terms of planning, what you kind of want to do is take a look and see like, okay, what is my anticipated income for the year? What are my withholdings? What is there going to be like an anticipated tax liability come April? Because then at least like, even if there isn't something you can do to lower your tax liability, you're aware of what that's going to be and what that payment amount you're going to have to pay come April is.
Yeah, I think that's such a good point in that, okay, we can talk about all these fun tax planning strategies, but some of the biggest frustrations that I see too is that they're just not prepared for the tax. Like they've just not withheld enough. They're surprised when the tax comes. Now they've got to dig out of savings or whatever that is. So I think one of the most basic things anyone can do to just plan for the tax towards the end of the year is check your withholdings. And I know the IRS has a withholdings calculator tool. Outside of like checking with their tax professional or checking with their financial advisor, like what other tools do you see that are really helpful to do that?
There is some tools. The issue with that is there's a lot of tools online that aren't like very good at calculating like withholdings calculator for your tax liability. I guess it depends on what you're doing. So if you have a CPA, I would just send them, hey, here's a copy of my, November pay stub. Can we prorate this out to the end of the year so we can get like an estimate on what my liability is going to be? If you're a type of person who uses like TurboTax or TaxAct or just files tax software on your own, I would maybe use your previous year's tax software and enter your current year's information into that, just where it's like you have your projection on what the withholding is going to be, what your income is going to be, and kind of on that see what your anticipated tax liability is going to be, because that's going to get you within a range of like, it can get you like a pretty good estimate on, it could probably something along as, oh, I'm going to owe $2,000. Well, then at least, like I said, you're going to know that 5-6 months in advance, or so that you don't have to be scrambling last minute to pay an unexpected tax bill.
Yeah, exactly. And there's a few more rounds of payroll to run to the end of the year. So if you can, it might take a few weeks sometimes to update that withholdings. But yeah, check with your tax advisor, check with, maybe use some of these calculators, check with your advisor. Financial advisors can often, like for me, this is about the time of the year where I'm getting updated pay stubs and running our projections and trying to see what that looks like. So just check with your people, try to get that down as much as possible. And, let us in on an industry secret. Like, why are these withholding forms like so confusing? Like what's up with that?
It's just like something that I've always thought was weird because I think what the issue happens a lot of times too is that the a lot of ODs also out of school work multiple jobs. And how the forms kind of work is that it assumes, like, if say you're working for four different, you're working at four different places, you're getting paid on a W-2 for all of them. What the withholdings oftentimes happens is that it assumes that instead of you working four jobs, it assumes that the one job that you're working is your only job. So it withholds it, assuming that's your only income. And that's not true. You have, say, four sources of income where you're working, say, for example, like 1 day a week at four different places. And then it's like assuming that your weekly income is just that 1 day a week. So it's not withholding at the proper percentage. It's just something that I see happens a lot that we end up having to make sure we're correcting through either increased withholdings or making estimated tax payments throughout the year so that the person doesn't get hit with like a huge tax bill at once come April.
Yeah. And agreed with your point earlier in that retirement accounts are basically the biggest lever you have to either control taxes this year or, like you mentioned, that Roth account controlling taxes in the future. And I think a lot of what we're talking about is like there's this trade-off between deciding when to pay tax on income. Like anytime you're contributing to a pre-tax retirement account, yes, it will benefit you this year through a deduction from taxable income. It's going to lower your taxes, but it's going to impact your wealth into the future. And so there's this sort of trade-off you have to balance out of like this year's tax situation versus the future tax situation and kind of decide what's the best course of action from there. But your biggest lever as an employed OD is probably going to be that retirement account that's available to you through your employer. So an action item here, I guess, is to take a look at what you've contributed year to date. Take a look at where the max is based on the type of retirement plan you have. And then if you want to increase it to get to that max, then go ahead and do that. And for a 401k, if it's a 401k, the maximum you can put in as an employee is $20,500 for 2022 if you're under 50. For the simple IRA, it's $14,000 for the employee, and then if you're over 50, there's an additional amount for a catch-up for each of those plans. There are other things. There are health savings accounts, for example. So this is something you can use if you are on a high-deductible healthcare plan that is HSA eligible, and the maximums are, if you're single, $3,650, and if you're on a family plan, $7,300 combined for the family. And there's an additional amount if you are over 55, I think, for both you and your spouse if you're married. Those are really great tools, especially if you're doing it through your employer, through a cafeteria plan. It will save, it will lower your taxable income for income taxes, but also FICA taxes. It will save you on FICA on employment taxes too, if you're doing it through your employer. But you can also do it outside of your employer too to help with just income taxes as well. State taxes are different. I don't think many people know this for HSAs. State taxes may be different than the way federal taxes treat your HSAs, your health savings accounts. So just something to be aware of. Every state is a little bit different, so check with your tax pro. Joe, you seen anything weird with HSAs and state taxation?
Not particularly. It just depends on what state you're in is going to be like how deductible they are. It just varies state by state. So you just have to ask depending on what state that you're in. And then also too, like you said, kind of the decision with the Roth versus the traditional, whether you take the immediate deduction or you defer it down the road. There's so many factors that will affect that too. It's going to be lots of things where it's what's your income now versus what's it going to be in the future? How old are you? What state are you in now, and what state do you plan on being in when you retire? There are just so many factors where it really is just a case by case basis.
Yeah. So what? Let's go there. What are some factors you'd look like if someone asked you, like, should I be putting it into the pre-tax bucket? Should I be using the Roth bucket in my 401k? Like, what are some things you'd look at?
So first one I would say is age, because of the fact that when you put money into the Roth, it grows tax free, and that's the benefit of it. So the younger you are, the more I'm going to swing towards the Roth than the traditional. Second one is probably going to be, actually, I would say probably 1A and 1B is going to be age, and then what is the current tax liability on that? So what is your current tax level? So let's say someone who's in a lower tax bracket, I would recommend the Roth more than someone who's in like the top marginal tax bracket,
Yeah.
where they're in potentially a 37% federal tax bracket, and then whatever your state income tax bracket is. The higher your tax bracket, I'm going to probably more recommend traditional than if you're in a lower tax bracket. So I would say like 1A, 1B are probably age and what tax bracket that you're in.
Yeah.
Probably the second one I would say after that is, because this one is just way too hard to project, what is your income going to look like in the future?
Yeah.
That's obviously the hardest one to project because nobody has a
Yes.
crystal ball and can see into the future. You can kind of get an idea, but it's also just incredibly hard to project because that's also what is your income going to be in the future and what are your future plans? Because like in theory, if you were, let's say you were currently working in California, but then you were going to retire in a state with no income tax, like say Washington. So it's going to be more beneficial if you do pre-tax money now while you're working and have the California tax rate. And then when you pull that money out, you're in Washington and don't have a state income tax. So there's just so many kind of like future factors. The future factors are important, but they're really a lot harder to project. So the main things I would say is age and current income and tax bracket.
Yeah, I tend to agree. I've thought a lot about this, and in my work, we have financial planning projection software that can help us to figure out what might future income look like. But we have to sort of humbly say like we really don't know. I mean, there's so many factors that can change in the future that we really don't know exactly what not only future income is going to be, but future tax rate. And it's not just those marginal tax rate that everyone's familiar with. It's really what is the actual tax rate going to be on that income as you withdraw it. Because there's different sources of income too. There's Social Security, whether you're planning to take it early, delay it, whether you're going to have a pension. So for doctors working at somewhere like Kaiser or something like that, whether you're going to have a pension, an opportunity for a pension, whether there's going to be years before those things start where you can do Roth conversions. So there's all these different, whether you're going to be in a different state, like there's all these different factors. So I would have to humbly say like, yes, we can try to project out what the future looks like, but it's a guess. And I think we kind of have to be comfortable with that either way. I lean, like you said, like if your current tax rates are unusually low, or at least lower than we're expecting them to be later in your career, then I think going that Roth direction makes sense. If you're in a situation where you're in the highest tax brackets or where you're in an unusually high tax bracket, then I think that pre-tax version makes sense. If you're sort of in the middle, like these middle brackets, and you're not expecting much of a change, I'm comfortable going either way. What are your thoughts hearing that? What are your thoughts?
It just depends on the situation. If it's in that situation, it's just going to depend on age. Younger you are, the more likely I'm going to say Roth. The later you are in life, I'm going to say probably traditional. It's just mainly going to be on age and probably some other questions too. Like, and again, these are like the future ones that are hard to guess, where it's like, what age do you plan on retiring? And because there's some factors like that. That are kind of hard to project, but it's like it gets easier as you get closer to that. Like if you ask a OD who is 30 years old when you plan on retiring, and you ask someone who's 50 years old when you plan on retiring, obviously the 50-year-old is probably closer to retirement and can probably get you a more exact kind of answer.
Right.
So sometimes it's hard to project, but it's like you kind of want to get an idea, but then unfortunately no one has a crystal ball and can.
Right. Great. Yeah, that makes sense. And there's a couple things on my mind from if you're an optometrist who's built up a taxable investment account, so not something that's retirement related, but just some regular brokerage account like a Schwab or a Vanguard or something like that. If you have a taxable brokerage account, some things you can do there that can impact your tax return are going to be, one is tax loss harvesting. So if you have investments that have declined in value and you now have a loss, you can sell that investment, not to get out of it, not as like an investment decision or like a market timing decision, but you can sell that investment and then immediately buy something that's not substantially similar or not exactly the same, just to get that loss on the books. And there's rules to watch out to make sure this is done correctly. And sometimes the juice isn't always worth the squeeze there when doing something like that. But that's if you're like somewhere like this year where we're seeing a declining stock market, even in bonds, and you have losses in your taxable brokerage account, that's something to consider. Talk with your professionals about. Another thing to watch out for is we're getting into December, and December is usually where mutual funds, even ETFs, are going to be distributing income to the people that own them. And if you buy them in a taxable brokerage account, in a taxable investment account, just before they're about to do that, you're getting this income, but not having benefited from holding the fund the whole year. So basically, if you're buying it just before they're about to do that, and you're on the record there, you're going to get this distribution, and it's basically just going to add income to your tax return unnecessarily. So keep an eye on that. The date you want to look out for is the record date for each of these funds. So if you're about to buy a mutual fund or even an ETF into late December, just keep an eye on that. What date are they going to send out this income to all the shareholders? Anything else there on your mind, Joe, from a portfolio or investment perspective?
No, I would just say like mainly the tax loss harvesting is a good one. This is probably finally a year where there are losses compared to the past couple of years. So that's something definitely to look at in terms of tax savings there.
Yeah, especially if you've sold other assets for a gain, if you've sold other investments earlier in the year, or if you've sold a rental property, or if you're selling a practice like that can help offset some of those capital gains. And then if you have extra losses, meaning your losses take care of all of the gains, capital gains that you've created, and you have extra losses on top of that, you can deduct up to $3,000 of those losses against your other income, like your salary and things like that. And then whatever's left over can just be rolled over into future years. So some things to consider there. Let's transition to 1099 or independent contractor optometrists. What are some things above and beyond the W-2 considerations? What are some things that they should be thinking about?
Okay, so as a 1099 independent contractor, there's like a couple things that you want to make sure that you're doing. I guess first one is make sure you're tracking your expenses related to the 1099 jobs that you're working, and make sure that you're writing those off. Make sure that if you have any, licenses, insurance, items that are related to that work that you can write off, you are keeping track of that and doing it. Other thing is that most of the time when you're working a 1099 job, you do not have some type of retirement plan set up through the employer that you can use to put money into. If you are working a 1099, something that might be worth doing is looking at setting up a type of either like a SEP or a solo 401k. Those are both options that you can use to put decent sized chunks of money away into a retirement type account, where if you don't have that option at an employer. Other thing that's going to be very common to do is, depending on how much money you make, which you could not do this for 2022, you would have to make that election for 2023 moving forward, but it might be worth it to set yourself up as an S corp, where you are creating a corporation. You are then paying yourself a payroll through that corporation, where you're paying the payroll taxes on that salary that you're paying yourself, but then you're not paying salary on the entire amount of income. You're paying a certain portion of it on salary. You have to take a fair salary for your profession, and then the rest can be taken as a distribution. Because the issue is right now, if you're just a straight 1099 reporting your income on a Schedule C on your individual return, you're paying that 15.3% self-employment tax on the first $153,000 of income.
Yeah.
Where if you take a salary, if you take it as a S corp, and then you are paying yourself a salary, you can end up saving probably 6 to 7K in self-employment taxes a year by doing it that way, depending on what your income level is. So it's something that you want to check and see with your accountant, whether the additional cost of running a corporation is worth it in terms of tax savings, but it's something that you'll want to explore. And again, this isn't something that's really year-end tax planning. because you can't elect this for 2022 at this point. You would have to elect it for 2023 by March 15th, 2023. But that's definitely something you want to really look at for if you are a 1099 OD, whether at your income level that makes sense to do.
Got it. So that's more future, longer term planning there. And so you have an independent optometrist or independent contractor optometrist. How do they think about setting that reasonable wage? Because they're required, like you said, to provide themselves a reasonable wage. They're going to pay employment taxes on that wage, and the profit above that is really where that tax savings is in terms of employment taxes. So how do they think about? I mean, they're on their own. They don't have other capital in the business, right? They don't have employees or a system or process. Like how do they look at or think about finding out what is a reasonable wage for them?
So it's really weird. There is not really specific IRS guidelines on this. I've seen for optometrists as low as 60,000 a year, but it's kind of one of those things where like I think like ideally from what I've seen, it would be somewhere probably between 80 and 100,000, depending on the state. But it's just kind of like there isn't really a clear guideline on that. You just want to find something that works that you can justify to the IRS. And because then the thing is too, is that like it's going to depend on the income level. The ones where it's like a lower wage, it's usually you want it to be at least where it's like, okay, if it's a lower wage, well then is it 50,000 or sorry, not 50,000, 50% salary, 50% distributions is kind of what you're taking as income. But then also there's a cap where I would argue there isn't a need to pay yourself over 100,000 as an OD. But that's kind of where you're at. So you kind of want to just like, it's going to depend on so many factors. What's your total income from the 1099 work? What state are you in? But I would say it's some type of range, usually from what I've seen for optometrists, between 60 and 100,000.
Got it. Okay. Interesting.
Kind of a little bit of a big range, but.
Yeah, I guess it's fair to say just talk to your tax pro, get some documentation so you have some standing there. It's legitimate in the case of an audit. And is there I guess I'll ask it the other direction. Is there a range of profit, meaning like your net income from your work above that salary where it starts to make sense to choose to be taxed as an S corporation?
I'm going to say 100,000 is usually the number where I start to recommend it.
Got it. Yeah. Cause like you said, it's there's that employment tax savings, but it also impacts there's this QBI deduction, and maybe you can talk about this as well, that you're eligible for. Changing the way you're taxed impacts the way that QBI is calculated. There's additional costs to then file a tax return to run this. Payroll costs. Now you have to do things if you have like a 401k, for example, solo 401k, you have to run it through payroll. So there's some additional things to keep in mind.
Yeah, there's other factors too, and it's just going to depend on your exact situation. Because the QBI deduction, we want to make sure that you're qualifying for and having as much money eligible for that as possible. There's a lot of factors where you kind of really just want to make sure you're talking to someone about your individual situation and if it's worth it to do.
Yeah, and that QBI, that's a 20% deduction, essentially. Basically against like your net business income, I guess, to state it really basically, right?
Well, correct. As long as you're under certain income levels, because optometrists are considered specialized service business, like accountants and financial advisors as well, where that income is only qualifies for that under a certain threshold of income, where if you're a 1099 OD, you're probably going to be under that threshold.
Yeah.
But that can change as you get above that into different points in the future with more optometrists that have their own office.
Yeah. And you mentioned the solo 401k or SEP IRA. Solo 401ks are just awesome planning tools for self-employed or independent contractors. They give you the ability, it's similar to a SEP, but they give you the ability to contribute not only as an employee, you get that employee max up to $20,500 this year, but also the employer portion as well, because you're technically like a little small business as an independent contractor. So solo 401ks are a really powerful option. You can actually open those after the new year, even specifically for the employer portion of that, and also after tax contributions. So there's There's a lot to consider there. I think those are really powerful planning tools. You mentioned any expenses, I think, related to your work as an independent optometrist. Self-employed health insurance deduction, is that something they can look forward to as well?
Correct. Yeah. If you are working as a self-employed individual and you have costs for health insurance, you can deduct that directly. You're not subject to the 10% of medical, 10% of AGI that other medical expenses are subject to. You're able to write it off your health insurance.
And self-employed is, we say that in this conversation, and I think people think that just means that they're on their own, right? Like they own a business, they're self-employed, but that's really a tax term, right? There is a difference between self-employed and if you are filing taxes as a corporation, right? Can you explain that a little bit?
Yeah. So if you're just self-employed and you're not like a full, if you don't make an election to be taxed as an S corp, because you can still be an LLC and you pay tax, just one tax return on your individual return. But basically, what it is that like you're doing a separate schedule on your tax return called a Schedule C, where you report your, I'm going to say, business income or 1099 income. But then you have your 1099/business income. You report all of your business or 1099 expenses. And then you get your net number at the end, which is your net income, which then goes back and carries to the front page of your tax return that adds to your total income.
Got it. Okay. And if you are, because if you are self-employed, we talked about there's this deduction for your own health insurance premiums. Mm-hmm. How would that work if someone is choosing to be taxed, like we talked about earlier, as an S corporation? How is that different?
So the only difference is you would still get to deduct the self-employed health insurance. You just have to report it in a different way, where on that S corp you are paying yourself a W-2 wage, and then you just have to report the health insurance as part of your W-2 wages. And then so it shows as part of your income, and it's deducted by the S corp as their income, but then there's a separate line on your tax return end where it's reported as additional income on your tax return, and then it's deducted at a later point on your tax return for the self-employed health insurance deduction line.
All right, so some tax accounting silliness, right? The same result, there's basically just a few extra steps in the way that that's done, right?
Yeah, I want to say it was like 2013, they made it like a rule where you have to report it the specific way.
Got it.
So it's just something that you need to do on your W-2s if you're being paid. Yeah.
Okay, that makes sense. And any other thoughts or concerns, things to keep in mind specifically for these independent contractor optometrists?
Other thing, kind of same as W-2 employees. The only difference is for this one is you're not having any withholdings taken out throughout the year. Yeah. So mainly make sure you're either chatting with your accountant or doing some planning where you figure out what your tax liability is going to be at year end, because it can be a potential pretty big one if you're not planning for it and have all of your income coming through as a 1099 employee.
So, that's another, just be prepared for that tax. Another question I have is, let's say that independent contractor is choosing to be taxed as an S corporation, right? Mm-hmm. So they have the wage, they have the salary coming out through the year. How do you usually see that balance between just increasing their withholdings through that payroll versus making quarterly estimated tax payments?
Usually you just do it. For most doctors that I see with it is that they pay themselves like a really small salary throughout the year and then just bonus themselves in amount at year end where they
interesting. Yeah.
Because what it is that, like, and I guess it's just kind of like a little weird rule, but when you pay yourself withholding on a W-2, it counts it as being equally paid throughout the year, no matter when it's paid. So oftentimes what I see happen is that doctors will pay themselves like a really small salary throughout the year, and then they'll have they know they're going to have this big check. But if you don't make equal payments throughout the year through either quarterlies, you often get penalized when you have that tax at year end. So what they do is on their December 31st payroll, they'll pay themselves like a big payroll and then have it almost all go towards withholdings where it covers their tax liability. So it lets you kind of like keep that money throughout the year without actually paying it. But then so you can, use that money somewhere. It gives you like extra use of that money for the year, but then you don't get any like penalties on it. So it can be like an example where they give themselves a $50,000 bonus at year end. You're going to owe $45,000 in taxes. You have $45,000 of withholding taken out on it. And then that covers your tax liability, and it treats it then as being paid equally throughout the year, so you don't
Yeah.
get hit with any quarterly payment penalties.
Interesting. That's a good idea. Bonusing at the end of the year. Okay, let's talk about practice owners. Right? There's a lot
Mm-hmm.
more levers to pull here when you own a business. There's a
Mm-hmm.
lot more you can do and think about above and beyond what we talked about earlier. What are some things that practice owners should be looking at in their tax planning towards the end of the year?
So the main thing is kind of like get an idea of where your income's looking like for the year. Um, Oftentimes, main thing I kind of like look to go through with people is um, first question I ask is like, okay, was there any like equipment purchases? Was there anything you're looking on buying in the short term? And then oftentimes they'll say like yes or no. If they were looking at buying something in the short term, and we kind of look at like, okay, what is income this year compared to what is income projected in future years? If it was a really good year, I would say like, hey, any reason we don't want to buy this now? So we can write this entire amount off now. You'll get the immediate tax benefit of you'll get the, potentially higher tax rate that you're deducting from, and you get the immediate tax benefit where it's like, hey, if you're in state and federal, your combined tax rate is 40%. You can say like, hey, you can buy this $50,000 piece of equipment now, and then you get the deduction on it, and you save 40% of that off your tax bill come April, which is $20,000. So that's kind of the main thing is going through, okay, anything that you're planning right now or in the future in regards to your business in terms of like equipment purchases. Then it's going to be kind of similar type things, making sure we're writing off everything that we're allowed to write off, making sure you're maxing out retirement plans. Oftentimes, I guess there's a lot of stuff with like business owners that are kind of like, the thing is that there's a lot of stuff too that it's like small stuff where you'll think like in the short term this is going to make that much of a difference, but then if you do it kind of like year over year, it does make a difference. So that's kind of like a couple of the things that you want to make sure you're doing every year. Second thing, a lot of it too is just going to depend on the size of the business. Oftentimes, there's going to be like some like income shifting stuff too, where like once kids are a certain age, you can have kids work in the office where you're documenting what jobs they're performing and pay them for those jobs, which then moves income from a higher bracket to a lower bracket. That doesn't make as big a difference as a lot of times people think. So maybe if you do that per kid, you're maybe saving like $600-700 a year in taxes. So it's not really a huge difference, but something to look at.
Yeah. So let's. I want to jump back to something you just said, and that I know emails. I think ODs are going to be getting all the emails towards the end of the year, like buy this equipment. From if every manufacturer is going to be sending out these emails. Somehow I'm on these email lists, so I'm getting them too. But buy these instruments to get your Section 179 deduction or bonus depreciation. Like, how does that work? Because when they buy this equipment, assuming they need it, right? Assuming it actually serves a business purpose, right? That's first thing.
Yeah.
You don't want to spend $1 to save 30 cents or so, right? You want to make sure it's going to provide something to your practice. But when you buy it, you have some options, right? You can depreciate it over like a regular schedule, or you can use one of these rules to accelerate that depreciation into 1 year, right? Is that what you're referring to?
Correct. Basically, you would make the election to have the asset fully depreciated in the year that you purchased it.
Yeah, and you're seeing, especially if there's an especially high tax year or a high income year in the practice, like that's especially somewhere where you're going to want to accelerate that depreciation into that 1 year, right? Would you see where it makes sense to spread that out over the regular schedule? Like, are there times where you would, instead of taking it all at once, to just depreciate it over that regular, 5, 7, whatever year schedule it is?
Yeah, no, there is definitely. It's oftentimes the most common with that is with like cold starts. You buy a lot of equipment to start. You have a ton of expenses already, so you have a big loss that first year. So it's like, okay, we don't need to pile on this loss more where it doesn't really get you any benefit. Let's spread this deduction out over a 5 or 7 year period, depending on the asset. Usually with cold starts, those are the ones where I'm like, yeah, let's not take this 179 or bonus depreciation right now. We want to spread this out over a number of years.
Got it. Yeah. And that goes back to, again, that conversation we were having earlier. There's a balance between taxing income now versus deferring it into the future. There's also a balance between taking deductions, all in one year, taking it now versus spreading out deductions into the future. You want to find that balance to get the biggest effect from all that. And one thing I've been thinking about too, and we mentioned there's this QBI 20% deduction, and according to current law, that deduction is going to sunset, or it's going to essentially end starting in 2026 and beyond. Mm-hmm. Now, we don't know whether that's going to actually happen. It could just be continued on from that Congress. Who knows? But, there's a thought that you can say, well, I may want to postpone my deductions until that point, because if I take deductions now, it's going to lower my net business income, which is going to lower my deduction I get from that. Like, is there anything like that where you're thinking about maybe I should delay taking deductions versus taking it earlier? Or is that too unknown? Like, is that just something that's sort of too unknown?
It's too unknown because historically with those types of deductions, they always get extended.
Yeah.
So I'm kind of thinking that's probably likely to happen with that, even though there's nothing there right now. Historically, most stuff like that always ends up getting extended.
Got it. Yeah. Yeah, things are temporary until they are continually extended and extended. Tax laws are permanent until they're all of a sudden not, right? It's usually how it works.
Yeah. The only thing that's an issue with that I think is going to be for people, oftentimes what happens, there's all these like contingency kind of deductions. And then let's say you had one that was expiring at the end of 2022. Oftentimes it doesn't get renewed until like late November 2022 for the next year. So oftentimes you're kind of like, you end up in a point where you're like waiting to find out, like, is this going to extend or not? But it's unfortunately something that, we have no control over and kind of just have to. If I had to guess and could use the crystal ball to look into the future, I would assume that QBI is going to get extended, but you never know.
Yeah. Yeah. You don't know. I kind of feel the same way you do, but, we'll see who's in Congress at that point and what their appetite is to change tax law. But so you talked about retirement accounts, like you said, that is a huge lever for a practice owner, similar to a self-employed optometrist, and you have the ability to contribute. Let's say you have a 401k account. You have the ability to contribute as an employee. You have the ability to do profit sharing up to a certain maximum, and then if the plan allows, you can do after-tax contributions too, which leads into something that people call a mega backdoor Roth IRA. So it's a way to get additional dollars in your 401k into a Roth bucket in the 401k. So there's a huge benefit to use that above and beyond what a W-2 employee can use. Retirement plans are a huge lever to pull. You mentioned employing kids. Can you talk to us more about that? How exactly does that work?
Oftentimes what people do is they'll employ, for teenage kids, it's going to depend on the state where there's an age limit. Teenage kids, oftentimes what happens is they employ teenage kids, pay them enough so that their kid can max out a Roth IRA.
Yeah.
So it allows them to get money into a Roth. You just have to make sure you document what they're doing in the office to make sure that you can pay them. Other one with like younger kids, a lot of time people do is they pay them like a modeling fee, and they'll model, like take pictures and have them as part of their website, and pay them a modeling fee where same thing. These ones are usually paid as a 1099, but you pay your kid a modeling fee, pay them make sure you're actually using those pictures as part of your advertisement, part of a brochure, something that's advertisement. And then using that money to max out a Roth for their kids, and just gets them earned income so they can contribute money into that.
Yeah, that compounding. I mean, if you do the math over, let's just say it's that 6,500 limit over, how many years into the future as they grow and get older, that compounding can be substantial. And you mentioned usually as a 1099, so they're usually paying their kid as a 1099. Why is it 1099 versus like actually on payroll?
Because usually if someone's a model, they're not like an employee. They're showing up for a photo shoot where you're taking photos. Because then also too with that, then you don't have to deal with, depending on the state, unemployment insurance.
Got it. Okay. Makes it a little bit more simpler there. And we talked about setting a reasonable pay for the work you're doing. Like, how do you actually think about what is a reasonable amount to pay your kid if they're working in the practice?
Usually it's going to be kind of based like what I always say is that usually what you're trying to do is just paying them enough so that you can put a Roth in their name, which would be after payroll tax, right around a little over $7,000 a year.
Mm.
It's kind of depending on what their tasks are. You're going to kind of want to look into like, hey, what's a regular summer job? What are their tasks that they're doing? What are they actually doing for the business that you can give them a job for and see like what that would actually pay. I mean, you can boost it a little bit, but you don't want to have some ridiculous salary go into your kid's name that you could not justify.
$50,000 salary for your 8-year-old.
Yeah.
I think that's reasonable, right?
Yeah.
Okay, so we talked about paying your kids, which not only helps you from a business standpoint on a deduction, but can also help them to grow some wealth towards their future too. What are some other things? Something I hear come up a lot is can we get a home office deduction for a space we use in our house for work? Like how does a home office deduction work for a practice owner?
So you can, it just has to be exclusively used for business. So basically what you need it to be is like office that's exclusively used for business. And then you'll be prorating your home expenses by the home office square foot compared to your total house square footage.
So even if it's like a small little corner of a bedroom, if there's a desk there and it's only used for business reasons?
It's supposed to be its own separate room.
Oh, got it. Mm-hmm. Okay. That makes sense. Yeah. And another thing that comes up is the Augusta rule and staff meetings or leadership meetings at the home of the practice owner. Has that been something that you've come across in your conversations? Can you tell us a little bit about that?
Yeah. So what that is usually is you're paying like a certain amount. I can't remember the exact amount off the top of my head to have like a home meeting at the officer's home once a month where you're getting, food, everything, etc. for the officers, for the employees to go and have this event at the homeowner at the practice owner's house.
And it's a up to 2-week period during the year where you're able to do this and not have to treat your house as an income, right?
Correct. Yeah.
And so is there any, what are ways to do this right? Can you just pay yourself, can the practice owner pay you whatever you want? Like what are some ways that a practice owner should do that correctly? Or what are some things they can keep in mind?
There's like a certain amount. I can't remember what the limit that they're allowed to pay per day off the top of my head. I'm actually trying to look that up right now.
Got it. Okay.
But there's a certain limit that you're allowed to pay yourself per day on that.
Got it. And I guess as you're doing that, if you're able to find it, but if not, I think it's just good to say it needs to be a reasonable rate, something
Correct.
that you would pay another venue to have your meetings and host your meetings, right? You can't pay yourself just a ridiculously high amount just because there's a tax benefit. You need to have, like all things, you need to have some way of substantiating that it makes sense, that's reasonable, and you need to be able to prove that in the case of an audit. So I think that's important to note there.
Correct. Yes, it needs to be a reasonable amount, and a lot of it can be like fair market value of your home for renting it for a day. If you look at like Airbnb and can find something similar, but yeah, it's under 14 days, and yeah, it doesn't give you an exact amount, but it says determine the fair value of a daily rental.
Got it. Okay, so if you're planning a leadership meeting to plan for the end of the year and plan for the next year, maybe having it at your house as a venue. It can make sense. I guess.
Correct.
Like all things, talk to your tax professional and make sure you're doing that right.
Correct.
Anything else that a practice owner should be thinking about as they sort of wrap up the end of the year?
Again, kind of just like everyone else, just make sure, doing what you can to lower tax liability. And then if you are doing planning, then also make sure that you're setting enough aside so that you're prepared for that tax liability come April.
Again, goes back to check your withholdings, check your estimated tax payments. Just make sure you're on track. You don't want to be surprised by the tax bill when it comes due. And one other thing I've been thinking about is just make sure your bookkeeping is accurate throughout the year. You want to make sure that you're not double counting income. Make sure that your expenses are getting onto your books and that they are accounted for properly. And it's much, in my opinion, it's much harder to do that at the end of the year when you need to give it all to your tax professional than if you're just doing that throughout the year or just working with a bookkeeper to make sure that they're done done appropriately. Is there anything that you've seen that's helpful to make sure that these books are accurate for these practice owners throughout the year?
Just make sure you're keeping on top of it throughout the year. It's hard if you put it off for a long period of time and then try to catch up. So if you're going to do that, get a bookkeeper to do it on a monthly basis. But at least like if you're going to do it on your own, make sure you're doing it at least like reconciling everything once a month is probably.
Yes, reconcile every account. Again, the easiest way to not overpay in taxes is to make sure that you're not overcounting income and you're not missing out on these deductions. So just keep your books as accurate as possible. Any last thoughts? And we talked about a whole lot here, and any final thoughts and just kind of helping these practice owners think about, okay, is there anything else I should be looking out for as I prepare for the end of the year?
Main thing I would just say is just make sure that you are kind of just like, and I guess also to go back to bookkeeping, the bookkeeping is also really helpful because if you're having good financials every month, it makes it way easier to do planning from a tax perspective because you can take a look and see exactly where they're at every month.
Right. Decision making is much easier if you have the information to do that. So I totally agree.
But no, I would just say make sure you're kind of being proactive with your planning. I think it's usually good in terms of planning. It's not just year end, but I think it's important to do it maybe once during the summer, look over everything and see where you're at. And then once again at the end of the year, just so that you always have like a good idea of where income's at, where it's projecting to be, and what you want to make sure we're looking at all these different things that can potentially lower your tax liability.
Got it. That makes sense. Yeah, tax planning starts early in the year and it continues on throughout. Well, I really appreciate your time here, Joe. I think we have so much to dive into here, so much information. And if people want to reach out to talk with you more, learn more about what you're doing, how can they find or follow you?
Best way to find me would be through email, which is joe@ericksontaxes.com. And then you can also find me at my website, which is ericksontaxes.com, has a phone number, address, and then my email address is probably the best way to contact me though.
Got it. Yeah. And in preparation for next year, like when should they get in touch with you? Let's say they want to work with you. Like what should it be now? Should it be after the new year? Like what does that look like?
Now is perfect. Like anytime between now and the holidays. I know a lot of times people get busy during the holidays. So I would say probably November's good. This month's good. Beginning December's good. Or also January's good as well. Just before it gets crazy busy for tax professionals then. So yeah.
Yep. That makes sense. And again, get in touch with Joe or your tax professional, keep in touch with your financial advisors, just keep in touch with your people. You know, everything we talked about, like this is all educational, but you need to figure out what actually makes sense for you. Like what actually will have a positive impact for you in your preparing for taxes and helping to lower your taxes. And some of these things can be done, or I would say very few of these things can be done after the new year. A lot of this has to be done before the end of the new year. So keep in touch with your people. Joe, I really appreciate your time today. It was a lot of fun for me, and I do mean that honestly. This is so interesting for me to talk about, but for everyone else, for the listener, appreciate your time, and we will catch you on the next episode. Take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.